The financial system is at risks. The banks are in crisis right now. You came here for the truth, so let me unveil that for you. In today's video, I'm going to break down everything that's happening right here and right now. There are some banks that are starting to collapse. Who are they connected to? Do we need to understand the depths of this? I can bring that all to you right here and connect that in future videos as well, because commercial real estate and of course, the banks are exposed to this to a great degree. We are talking about not just billions, but trillions of dollars at risk. Let me show you what's happening right here and now. U.S. property losses trigger a 20% drop in Japanese bank Ozora, and this is just one of many. I was talking about this. March of 2023, what did we have? The banking system started to experience a collapse. This not only affected small banks, but started to spread around the world very rapidly, and we saw Credit Suisse, one of the biggest companies in the world. It is considered to be a global, systemically important bank, and it collapsed so bad that, of course, they started to get the government involved. They had to bail them out. UBS comes in. The whole deal started to expand. I covered it extensively back then. And now today, the problem is still going on. This is a bank on the other side of the world being directly affected by what's been happening in the United States. This is why we need to understand how the dominoes fall. This is very intricate. Of course, the details aren't all there, but it's hard to sift through all of this information. We really don't know the level of exposure until it starts to fail. Everybody says Lehman was going to be okay. Everybody, including your friend Jim Cramer, said Bear Stearns was going to be okay. That didn't exactly work out the best way. Okay, so you could see property losses in the US created this panic, created this crisis, but it's just one of many. US property market, specifically on the commercial side, has been hit by higher rates. And why? It's because it's short-term debt. Short-term debt, unlike your 30-year mortgage you get on your residential property, it is not the same on the commercial side. Okay? Keep that in mind. You could see here became the second lender in a span of hours to surprise investors with losses tied to U.S. commercial property, sending shares down by the limit and heightening concern of the global bank's exposure to souring real estate bets and souring real estate bets. This is important because it's not just one company, but of course we see that industry-wide. This is Japan's 16th biggest bank, not necessarily the biggest in the world, of course, but it's not insignificant. It shows us that the problems are there. And of course, we also see that with New York Community Bancorp, which I will talk about in a second. Okay, so this is important with one bank. You can see several regional banks started to fall on this news. Why should we care about the regional banks? If they're small, shouldn't we just care about JP Morgan and the Goldman Sachs? Well, make you just to give you a little bit insight of as to how it works. A large percentage of all of the commercial real estate is directly connected with these regional banks. They are the ones doing the lending to the commercial real estate. And that, I believe, depending on where you're looking, it is 50% or greater on these regional banks. So it is a very important thing that we pay attention to what happens. You might say, I don't care. Why should I care? It's commercial banks. It's the banks. Let them take the losses. When they start to fail, they will start to lay off people, and that will have a broadened effect on the economy as a whole. You don't want to see that. Okay, that could be not the financial crisis from 2008, but a different financial crisis. We don't want to see that. Okay, it's very important. What else? This article, as you see here, dated March 19th, 2023. Signature Bank taken over by New York Community Bancorp after sudden collapse. So we have Signature Bank as well as SVB, right? This bank comes in, New York Community Bancorp comes in, scoops it up, they save the day, right? Well, then what happens? All right, you can see New York Community Bancorp, right now, worse off. It's worse off than it was when SVB and Signature collapsed. This is going back. We're now seeing this stock at the same level it was at in the year 2000. Unbelievable, right? But that could happen to any stock. You cannot have all your eggs in one basket, as they say. But certainly we don't want to be exposed to something like this because you're going to lose your shirt. It doesn't matter if there's a bailout and this and that. It's systemic risk, ultimately putting power and control, all the finances, into fewer and fewer hands. Because what's going to happen here? You know that there's going to be another one and another one and another one getting scooped up by the JP Morgans of the world. Isn't that so funny how it all works? What you're looking at is the regional banking ETF, broadly just looking at what's happening with the regional banks. And as soon as this news comes out, of course, they get smashed down. So SVB collapses, Signature Bank collapses, these stocks get pummeled. And, it's kind of been up and down, but certainly the direction has been up, moving back to where it was before. But this really sent those regional banks down quite a bit. Notice it wasn't all just today, right? Part of that is the fact that the Federal Reserve ended their schemes that a lot of these banks were trying to take advantage of, mostly the big banks, but they're trying to come to terms with the fact that you can't use the BTFP, that's the Bank Term Funding Program, which is like the emergency loans that were set up during this time 1 year ago as these banks were collapsing. They were using that because they could borrow from it at a cheaper rate, park it at the Fed, earn that spread in there. That's gone out of the window now. And so and also that BTFP ends entirely as of March, supposedly. So that shows us that lifeline for these banks is gone and the regional banks need it. I'm going to show you something important in relation to that. Hang in there. All of this is connected. Here we have it. Small bank cash, excluding the BTFP. That is actually at a level that is lower than it was when SVB collapsed, lower than it was all throughout 2018, 2019. That is a big concern. More and more cash is moving into the bigger banks. The large banks are okay in terms of their reserves, but that is not the case for the small banks. And that, of course, is a very big concern. They are restrained. Their reserves are too low, and that is a big concern. Higher interest rates have become a very big problem because a lot of the individuals have been moving their money out. They want it to be safer. They don't trust the SVBs of the world anymore. And so a lot of that cash has been moving out. So their reserves are minimal here at this time. Cracks in the commercial property market are widening to apartments. 16.5% of Arbor loans were past due in December. Apartment loans emerging as a problem area in the commercial real estate space. That's apartments. That isn't the worst of it, in my opinion. I think it is clear to me when we look at retail, when we look at office, that is a much bigger issue. But it's going on all over the place because that debt is short term. That's the important thing to note. Debt short term in the commercial real estate space. So, of course, they were getting super low interest rates before, not so much now, right? And the fact that credit is tighter in this market, in the commercial side. The cracks in the commercial real estate market are widening from offices to apartment complexes, with more than $67 billion of housing potentially distressed as borrowers struggle to repay loans extended during the height of 2020. Okay. And so this is just one particular company. They're talking about CLOs. What are they? It's the collateralized loan obligations, kind of similar to the CDOs, collateralized debt obligations. If you watch The Big Short, or read the book, The Big Short, or you were on this channel for a while, I have videos about this in my Easy e-course. Here, when you go to the main channel, scroll down to the bottom, you see that in there, broke it all down. What is it? Okay. Well, you can take a bunch of nothing and you could package it up. All right. And then you put put it in a package, you put a little bow on top, and you write AAA on it. And then you hand it off and people can invest in that. And then you take a big bunch of nothing, some air, you put that in a box and then put a nice little bow on it and you write AAA on that and you sell that off to investors again and again and again. And then you take like 3 or 4 of those things and you put those into an even bigger box. And then you put AAA on that and you sell that off into an investor. Those were the CDO squared, CDO cubed. And you're probably thinking, heck is this guy talking about? I talked about it in my first book. For those who read it, this is literally what they were doing. They were taking nothing, nonsense, the worst of the worst, packaging it up, getting their friends at the rating agencies to mark that as AAA and selling it off to investors. In this case here, and of course, there's varying degrees of quality, but that whole derivative nonsense is still going on today, but it become more popular with the CLOs. I've been talking about these for years, but CLOs are what this is all about. And of course, when you have this as a situation that's been going on for a while, we see that the stress is there. Why? Higher interest rates. That's what I warned about back in 2012, January 2012, my book released. I warned about that. Higher interest rates, and then all of this. I said that. Anybody who read my book, my first book, please put that in there. Higher interest rates, and then I said 1, 2, 3, 4, 5, 6, all these different things. Okay? And now we're seeing it. How did I know that over a decade ago? How could I have told everybody that would happen over a decade ago? The financial crisis and so on. It's pretty obvious because of higher interest rates. Now, I think they're going to cut interest rates. I think they're going to print money at some point. Okay, and that doesn't fix the problem. Well, we could certainly, let's just say, inflate our way out of a mess. 2 days of regional bank tumult netted $1.1 billion for short sellers. There's always profit to be made. And then, of course, you can see commercial bank deposits. Money has been leaving this year. And where has it been going? Well, it could be equities. It could be elsewhere. But certainly, and by the way, money market funds are starting to see an uptick as well, which is interesting. Where I think the biggest risk is right now is the commercial real estate. I've been talking about that a while. I wouldn't touch that with a 10-foot pole. People are just pouring their money in. They're saying, hey, I need something for cheap. And so they were buying into commercial real estate or the somehow connected, whether it's a real estate investment trust, whether it's stocks associated with that. It is very dangerous. It's precarious. It's a circumstance that I'd be concerned about. Just prior to recording this video, I got off my Finance Friday live session. We talked about all of this for over, my goodness, it was well over 2 hours. And I want you to be a part of that. What is this? Well, I break it down very thoroughly. We get into everything. I show you the charts. I talk about the top-down strategies. We talk about investing. I look at particular stocks. I look at overall themes. I answer your questions all in these live Zoom classes. Small groups. If you're interested, link is in the description at the top. And I hope that I will see you there. If you found this informative, hit that thumbs up button. I do appreciate it very much. And of course, as always, I'll see you tomorrow. Take care.